Good evening and a very warm welcome to First Issues. Last Friday, various stakeholders descended upon the Gaborone International Convention Center to hear the FNB half-year financial results. The bank recorded a 15% decline in profits after tax, which they say they view as an improvement from the 18% decline in profits after tax recorded at the end of the previous financial year. This performance is set against the backdrop of a global economy in which, although developed economies are said to be maintaining economic growth, emerging markets are facing severe economic challenges. Those who were present at the announcement were told that there is no clear sign yet of an improvement in commodity prices, which will lead to capital outflows, increased debt and fiscal deficits, as well as unemployment and stagnating economies for emerging markets. Botswana specifically is facing a subdued 3.1% growth in GDP for 2016, with risks to the downside. Low wage growth, contraction of employment in the mining sector, and high levels of consumer debt also mean the consumer continues to be under pressure. But countering headwinds such as a weak demand for diamonds and a drought-induced increase in food prices are positives such as the pula remaining strong and benefiting the reserve account, low inflation, and a strong sovereign credit rating. But what does all this mean for the banking sector? The CEO of FNB, Stephen Bagatsu, spoke of all the factors affecting performance.
These are the developments that we've been seeing around the banking industry. The period between June to December, we continue to see this moratorium that was imposed on the banking industry about 2 years ago. Obviously, that has an impact on fees and commissions. We are in discussions with the central bank around the moratorium, and we expect an announcement to be made soon. We have seen an improving liquidity situation. When we did this presentation in August, we did indicate that the industry was experiencing severe liquidity shortages. That situation has since improved as a result of a number of initiatives that I shared then, including the central bank cutting the reserving requirement from 10% to about 5%, and thereby reducing about 2.3 billion back into the economy. Other things that led to this improvement obviously include the reduction in credit extension. The low levels of credit extension have actually benefited the liquidity situation in the market. We know that we are experiencing lowest interest rates that we have seen in a long time. For the banking industry, that talks to our margin. We usually talk about the endowment effect that occasions the decline in interest rates. We know that there are the current stance with government, with the monetary policy, is expansionary. But despite that stance, we are still seeing growth indicators such as GDP, credit extension, consumption, and investment not growing in tandem with expectation. Credit extension, as I indicated, is hovering around 7%. And what is worrying us, or what should worry all of us, is the fact that this 7% is primarily driven by credit extension to the consumers. Now, that's not good for any economy, because when you look again at the statistics as of November, credit extension was sitting at 7%, but for the consumer, that credit extension was sitting at about 14%. Now, when you further break down that 14%, it actually shows that 8% was credit extended to consumers for mortgages, for residential homes, loans. About 8% was credit extended for vehicle and asset finance, and a whooping 17% is unsecured loans. Now, in an environment where businesses are not growing in order to ensure that there are job opportunities, where consumer spending has been eroded by a whole lot of factors, including rising water bills as well as electricity or energy costs, this is not good for the economy. because this bubble is going to burst and it's going to catch up with us. And the biggest worry for us is with interest rates where they are, and with our consumers extended to the levels that they are at. When interest rates start rising, we are going to experience some of the harshest impairments we have ever seen. The cost of compliance is a result of what is going on around the world, with a big focus on ensuring that banks do business right and treat customers right, as well as various legislations, including FEDCA, and a focus on the financing of various activities that are not seen in positive light. We have seen the cost of compliance and regulation rising. Now for us as banks, it has meant investment in systems in order to meet reporting requirements, as well as staffing various areas to ensure that we are compliant. We have seen increased competition. Some of the players in this market being taken over by other new players. Obviously, that has an impact on market share. I've already talked about the pressures that we are seeing around the consumer and the impact this is going to have on both impairments and non-performing loans. The stringent requirements around Basel II. With effect from January, we implemented the new Basel II with Bank of Botswana. That obviously has an impact for us on liquidity. It has an impact on capital, and most importantly, on the dividend policy that we pursue. We shared with you our customer centricity strategy. We are striving for perfection, but as you all know, perfection is very elusive, and we are hoping that as we strive for this perfection, we will somewhere catch excellence, and we will be able to improve the experience that our customers are getting from our branches and from the entire business. So there is a huge focus then and going forward on ensuring that we do what is right according to our customers.
To better navigate these conditions within the banking sector that the CEO has just detailed, FNB has decided upon some strategic areas of focus.
We indicated in August that there are a couple of areas that we are focusing on, given the environment that we are currently in. That we are going to continue with investment in the business because we believe that the situation that we're experiencing now is not a permanent situation, that the tide will turn, and when the tide turns, we want to ensure that the business is in a position to take advantage of the advantages of the opportunities that will occasion that tide. That we are going to focus on asset quality. We're going to focus on funding sources, on non-interest revenue, because when your loan and advances, when your loan book is not growing, you have to focus on other areas such as your non-interest revenue. And we're obviously going to focus on efficiencies in order to make sure that we're extracting maximum benefit out of our both our balance sheet and from the business. So some of the things that we've been doing around investment in the business include investment in infrastructure. We indicated that we are revamping our branches to give them a new look and feel. So far, we are in the process of revamping about 6 branches. We have relocated the Kanye branch to new premises. This is a branch that was in a bad state, that was dilapidated. We have since relocated it, and it's in a new mall in Kanye. We are opening 2 new branches. We still want to open 2 new branches. Now, the slight risk with this development is obviously the completion of the premises that we are targeting for this opening. But the people that we are talking to, the project managers that we are having these discussions with, have indicated that they expect they are in line with their targets. So we still expect that should they meet the targets that they have communicated with us, we will be able to open 2 new branches. in this financial period. We will make more announcements around the locations of these branches in future. As I indicated, we have this plan to 2020 where we are revamping and refreshing our branches up to 2020.
Another major area of investment focus was revealed to be their self-service channels, such as these, in keeping with their bricks to clicks vision.
We have continued to invest on the channels as well, the self-service channels. When we had this discussion in August, we had about 20 ADTs. We have grown the number of ADTs. We have almost doubled the number of ADTs. Remember that ADTs are deposit-taking ATMs. We have almost doubled the ADTs. We are currently sitting at about 36, and the plan is to get to about 50. Now, these ADTs work very well for us because not only are they convenient for our customers, giving them ability to bank 24/7, but they also help us in managing the queues in some of our branches. Most of our customers move out of the branches now and are using these ADTs. We have actually established that 30% of our deposits have actually moved out of the branches and are going through these ADTs. We are targeting to have at least 3 of these ADTs in every branch. Another thing that we are focusing on are the slimline ATMs. When we had this discussion, we had 28 of these. We are currently at 34, and we have a plan to roll out these so that we get to a number of 70. So for every village that has got at least 5,000 people, we plan to have this slimline ATMs. Another development is that these slimline ATMs were previously only used by FNB card holders. And what we are doing is we are working on the software to allow other card users from other banks to use the slimlines. There are a number of initiatives that we have around people. We have introduced scholarships for some of our staff members. We have attachments at group level. Over the last 18 months, we have seen more and more of our staff members going away to other subsidiaries, not only in South Africa, but all over group for attachments. We have introduced this future leadership program. There's top talent and graduate development program. So there are a number of initiatives that we have put in place to make sure that we upskill the people that we have within FNB, and also to ensure that the industry benefits, because one of the things that we know is that bankers move from one bank to the other. That for us signifies the fact that we have not, as an industry, done enough to train people to ensure that we grow our own timber and we don't depend on getting people from other banks.
The CEO of FNB, Stephen Bahatu, says in this time of moratoriums and low interest rates, as has been illustrated, diversifying sources of funding has become central to the bank's strategy.
Funding sources, as I indicated, we were faced with liquidity challenges in the period that we previously reported in. Some of those challenges necessitated that we approach or we depend on funding sources that impacted our results negatively. So there's been a lot of focus on ensuring that we diversify our funding sources so that we can manage our interest expenditure. So there are a number of products and a number of initiatives that we embarked on to make sure that we encourage savings in order to diversify our concentration on some funding sources.
Before making way for the Chief Financial Officer to share the figures of the half-year results, the CEO made sure to share the bank's continued push for perfection even in these challenging times.
The interest expenses has been a focus area for us. We have reduced that bill from a growth of 43% to about 20%. The big focus as part of our strategic plan on impairments has seen the impairments reducing from 64% growth to about 10%. In June, we reported a decline in profitability of about 18%. We are now reporting a decline of 15%, which means we are slowly crawling out of this hole that I mentioned earlier. Again, just to reassure that the strategy remains sound, and it is very clear that despite the challenges that we have experienced in the economy, our December performance is indicative of recovery.
Welcome back to the show as we continue to look at the half-year financial results that were presented by FNB just last week. The Chief Financial Officer, Makgaudi Bakwane, shared that the 15% dip in profits before tax recorded for the half-year ended 31st December 2015 is, however, a sign of improvement after the 18% decline in profits recorded at end of the previous financial year. The highlights of the half-year financial results include a 47.6% cost-to-income ratio, as well as an 11% increase in non-interest income. During his presentation last Friday, the Chief Financial Officer said some cost ratios indicate that the bank is performing relatively effectively. Could this be an indication that he is happy with the bank's overall performance?
At a cost-to-income ratio of 47.6. This is a slight deterioration from about 41% that we reported to December 2014. So what that means is that we actually had to invest more in the business in terms of infrastructure in order for us to boost revenue generation. So the ratio on its own appears to be deteriorating. However, we believe it's a good position to be in as we are setting ourselves up for future growth.
You managed to grow both your customer base and therefore your customer deposits, yet you still clocked a decline in interest income. How is this possible?
The interest income is a function of two elements, mainly interest income as well as interest expense. So from an interest income perspective, yes, we have grown the advances by about 6%. But that growth has actually been tapered by the decline in interest rates. So with interest rates declining by a cumulative 150 basis points, that means that our margins have been significantly compressed. On the other hand, with the current liquidity challenges that are improving, as we've seen the interest expense coming down, the growth of 20% on the interest expense also results in decline in the overall interest income.
Overall, profits after tax were declined by 15% for FNB. Surely this is giving the bank sleepless nights.
Definitely it's giving the bank sleepless nights because we obviously have high expectations considering the level of market share we also hold. However, we must appreciate that these fundamentals are affecting the entire banking industry on the back of decline in GDP growth, which has slowed down to about 1%. So it means that the economy itself is not growing. So credit extension in the market is declining, resulting from low investments by businesses. Mines are closing down, businesses are closing down, people are being retrenched. Therefore, all of these fundamentals affect the banking industry, and FNB is no exception. However, the 15% decline for us, we are not so phased because it actually shows an improvement given that we come from a point of an 18% decline by June 2015.
Welcome back to the show as we continue to look at the half-year financial results that were presented by FNB just last week. During the presentation, an environment in which the banking industry is said to be constrained by a challenged economy, moratoriums on price increases, reduced liquidity and other factors was described. We therefore ask the men at the helm of this company which fundamentals a commercial bank should not lose sight of in these times.
Consumers are under a lot of pressure from a debt perspective. Disposable incomes have not been growing in line with inflation, and we have seen credit extended to the consumer growing exponentially. The entire industry is growing credit for the consumer at about 17%. Now, it is very, very crucial that we do not lose sight of collection efforts. Because if we do that, then our impairments are going to run away with us. So it's absolutely crucial that we keep a tab on your impairments by focusing on your processes, by rehabilitating your customers, and by engaging your customers to ensure that you are keeping those impairments at acceptable levels. That's one thing. The next thing is obviously cost management. You are operating in an environment where your income levels are declining. But it's a very delicate balance to strike with regard to your costs, because there are good costs and there are bad costs. We are going to continue with our good costs, which are investments. Investments in our people, investments in infrastructure, as you would have seen with the ADTs that we are rolling out and various products that we are rolling out. What we are focusing on, which are the bad costs, are costs that the business should not have, costs that grow annually without anybody checking them. And we have the CFO who's got a cost containment committee, and that committee is interrogating all the costs throughout the bank.
It is very important that the bank has a sound funding strategy. So therefore, it's very important for us to actually diversify our funding strategy in order not to be reliant on professional funding, which comes at a considerable cost. Therefore, it's important for us to diversify our retail deposits as well as business deposits. On the retail side, we've put in different deposit accounts, such as flexi-fixed deposits, that are going to be able to help us facilitate this process of diversification, as well as elongating our funding book. That's a very important fundamental. It's important, and it will also then result in a reduction of our cost of funds. Secondly, it's very important for us to have a good focus on diversification of revenue streams. Under these conditions of declining interest rates, it's imperative for a business to actually look at other revenue streams. In our case, we're looking at improving our non-interest income diversification.
Present at the results announcement was Moatludise Babole, Research Manager at FNB. We asked him whether, in his opinion, the current environment is likely to get worse before it gets better.
I think if you remember from the presentation of the results, the expectation maybe going to the next few months is there's still a likelihood of some of the issues that we had in the year that the financials were reported under, issues such as a bit of maybe liquidity challenges here and there, issues such as maybe interest rate or obviously coming down a little bit further, which will pressure your margins as a result of that. Issues around credit extensions with the environment that we are seeing now, where businesses are not investing as aggressively as they were. So there's still that likelihood that you might actually see a situation where the industry is still a little bit shaky, but definitely from then on, then you probably see crawling out of that hole that you have alluded to. So it should get better, yes, but the challenges are still there that the industry will still continue to face in the next few months.